advancing to Vijay Marisetty's talk, and Indradeep Ghosh will be the discussant. The topic is: Are fintech loan apps harmful? Evidence from users' experience of loan apps in India.
Fintech loan apps, which is one of the hot topics in India at the moment. So we got some data, then we did some analysis. I'm going to make a presentation on this. This is with my co-author who's doing PhD at the University of Hyderabad. So you look at the digital lending landscape in India, it's growing exponentially over the last 10 years. But more so, you see that the market share of NBFCs, the non-banking finance companies, has increased more in the last 5 years. Earlier, it used to be the private banks who were into fintech lending. Now you see that more and more NBFCs are getting in to the market space. And it's not that well regulated compared to the normal lending practices in India. The question we ask is, is it a good idea to go for this rampant expansion of fintech apps for loans, mainly loan apps? Is that a good thing or a bad thing? So you have both sides of the story. So it's a great innovation, especially in terms of access. I work with farmers. I'm creating blockchain platforms for financial inclusion. I know how difficult it is for them to get a loan of, say, for example, 5,000 rupees loan in a rural village in India. So they have to lose 1 day of work to go and visit a bank, and so a lot of KYC, not even bank, even an NBFC office, a lot of KYC. They can't do the KYC properly. They have to hire someone to do that. So lot of frictions in the market, and eventually they're not sure whether they'll get a loan or not. On the other hand, if they have a mobile phone, they just need to upload few details, and you get loan instantly. Your bank account will get credited. So in terms of the innovation, it's great. It's a great access tool, especially for financial inclusion, and the lending costs are relatively low in terms of search costs, not in terms of the interest costs, but in terms of search costs, they're much lower, and less paperwork, no collateral needed. So it's like a heaven. If someone needs 5,000 rupees, they're desperate to have 5,000 rupees. Downloading a loan app and then getting 5,000 is not that difficult right now in India. So in terms of the good things, I think this is the good side of the story. But on the negative side of loan apps, one thing is, you don't know what, when you download an app, you make a lot of agreements in terms of sharing a lot of information. So you share your social network details, you share all the WhatsApp contacts that you've got, and you don't know what they're going to do with this data. And we hear a lot of stories that they try to exploit this data, and they harass you eventually. I'll show you some newspaper articles on that. So trust is a big issue, and can you believe it or not? And most of these apps are not, developed in India. Most of the apps come from, in India are coming from China. So these are the concerns that we have in terms of trust, privacy, and also the interest rates are very confusing. For someone who is not financially literate, most of these people who go for loan apps, they're not financially literate people. And for them, they can't understand what is the rate of interest that these loan apps are charging. So you have that side of the story too. So we thought of looking at what is the story of users, how based on their experience. So the motivation from this paper came from a lot of news articles and a lot of incidences in India where people who have taken the loans from the loan apps committed suicides, and the government banned some of these apps, saying that they're all fake and fraud apps. And so all these, it's keep happening, and every day there is a news article that comes out saying that someone committed suicide after using the loan app when they were not able to repay the loan. So this is a big issue, a big concern in India. Not just in India, loan apps are there everywhere in the world. Even in the US, if you go, there are loan apps. But I think the issues seems to be much more prominent in India in terms of these kind of negative effects of loan apps. What literature says about fintech in general, yeah, for financial inclusion. Now you look at the literature is all about the good things about fintech. So fintech really makes financial inclusion much more accessible, and people do get access to finance, and that leads to their growth, economic growth, etc. And especially during the COVID time, fintech loans have been a great source of accessing finance, and they've done a great job as per the literature. So compared to traditional lenders, now there are few papers that are saying that fintech lenders are outperforming the traditional lenders in terms of the amounts they are lending to the borrowers, and so especially they did an excellent job during the pandemic period. So, how can you really find out whether the loan apps are good or bad? Not an easy question to answer, because you won't get the data unless you become a customer. So you have to access the loan app, download it, and raise a loan request. Then only you get to know what's inside. And so that's again one data point. How can you get other people's data? So it's difficult to track and get information about the loans and the interest rates, etc. On top of that, there is no proper regulation where the regulator says that this information needs to be disclosed to the regulator or to the borrower, to a common body, a repository. So we don't have any information about what are the rates actually charged and how the loans are disbursed, etc. So it's not easy question to answer. So we try to look at another route to answer the question by looking at the user's experience. So if you take a typical loan app, I'll come to this slide in a minute. So a typical loan app looks like this. You have details about the app name, the user rating of the app, how many people downloaded the app, how many reviews are there on a given app, what are the loan features, etc. And you also get information about who gave the review and what is the review. You can read the review and what is the rating of a given reviewer. So we try to exploit this kind of data to answer the question. So we set up a methodology using NLP methods. Broadly, two types of methods. One is an LDA, which is mainly topic modeling, and the other one is LIWC, where you try to gather the psychological context or content of a given reviewer or a writer. So you can pick up like their tones, how do they perceive risk, are they sad or happy when they write the review, etc. This can be captured through LIWC is a software developed by University of Texas Austin. A lot of researchers use to understand the psychological dimension of a given writer. So we use these two tools and we do some regressions and mean difference tests to answer the question. So we downloaded the loan apps. There are about 110 loan apps, and 45 of these are in the pre-COVID time. They came onboarded onto the Google Play Store platform. 65 during the COVID time or post-COVID, and we gathered around 2.19 million reviews over this time period from 2019 to 21, and we also captured all the loan features of a given app. I've shown you this. So these are some descriptives here. The number of loan apps are increasing. There are much more than these loan apps. 110 loan apps is where we could get a lot of data. The remaining loan apps, we don't have much data. So you see that most of the loan apps came after COVID. And in terms of the reviews, reviews were relatively low during the COVID time, but on the higher side pre-COVID and post-COVID times. And the reviewer scores are highly polarized. You have either very positive review or negative review. So there is a possibility of fake reviews. We try to address that kind of issue in the analysis. And the reviewers were not happy that much. So their high rating has come down significantly during the COVID time. So user feedback based analysis is now getting an established field of research. You see that in many disciplines, in marketing, in finance, in organizational behavior, etc. So this is not something new. And especially you see a lot of well-established papers in tourism industry, health and safety industry. There are people who are exploiting this kind of data, trying to answer some questions. So if you take a typical LDA model, you take all the text data and you try to go through a process where you process the data through tokenizing it, cleaning it, etc., running a few codes. Then it comes out with broad topics under which it can group the data. And then you try to look at those topics and the common words in those topics and come out with labeling. So once you label, then you try to use that as a variable. So for every given review, you can label it. So for example, here, if you divide all the reviews above median as positive reviews and below median as negative reviews, so these are the common words as per LDA model. And you see that you can come out with some topic labels based on the words that are commonly coming out in the review. For example, fake, fraud, etc., reject. So we call that as fraudulent behavior of a given loan app as per the perception of the reviewer. So likewise, if something is about, recommend, so excellent, amazing, useful, then I think you classify that as recommending a loan app as a topic label. So we came out with these topics. So we have altogether 8 topics that we can label each and every review. So if you use a word cloud, you can see that the most prominent words pop up. So among all the topics, about 20% of negative reviews are connected with fraud. So fraud is a prominent topic in loan apps. Then LIWC, as I mentioned, is again a tool that classifies data into different types of psychological tones of the reviewers. So we picked up some prominent tones, 7 of them, positive, negative, in terms of emotions, tones, sadness, and risk. Then we do the analysis comparing pre-COVID with post-COVID and comparing just the apps, pre-COVID issued apps and post-COVID issued apps separately. So if you look at the mean difference analysis, you see that on average, if you look at the whole data, on average, fraud has come down in terms of reviews in the post-COVID period or COVID period compared to the pre-COVID period. And whereas interest rates, for example, on average have increased during the COVID period compared to the pre-COVID period. So on average, you see that things have become better during the COVID period compared to the pre-COVID period. But when you look at the tones or the psychological perception of the reviewers, negative tones have increased. Yeah, I think I have more time. Yeah, 20 minutes. Yeah. So negative tones have increased during the COVID time compared to pre-COVID time, and then the positive tones have reduced during the same time. So there is some kind of inconsistency between LDA and LIWC analysis. So we divide the data in a different way. So we divide the data based on applications. So the applications that were onboarded before COVID and during the COVID time, then the results are quite consistent with the LIWC analysis, saying that those apps that came during the COVID time were much more fraudulent. And likewise, LIWC analysis clearly says that people are not happy with the apps that came during the COVID time compared to pre-COVID time. So in terms of the features, again, the applications that came during the COVID time, they charged more interest, and they had much lower loan tenures compared to the pre-COVID time apps. So the same information has been reflected here. And we ran some regressions, and you can clearly see that all the negative reviews are highly significant during the COVID time. Fraud was much higher on average during the COVID time, and poor customer service during the COVID time, more technical errors, and high rates of interest. Same thing in the case of psychological dimensions. COVID time, people were more unhappy with the apps, especially in terms of, so if you look at the dimensions here, they perceive the COVID time apps are more risky, and so they're less positive about the apps during the COVID time. Now, there is a possibility that a lot of reviews could be fake reviews. So maybe the creators might be writing, the bots might be writing the reviews, trying to prop up. So that's an issue with this kind of data of 2.19 million. So we try to exploit the government's decision, the Reserve Bank of India's decision, listing out the fraud apps. So Reserve Bank came out with a list of fraud apps. So now we can identify which of these 110 apps are fraud apps, which are not fraud apps. So now we try to predict the probability of fraud, and whether these LDA variables and LIWC variables can predict the extent of fraud. So the hypothesis there is that if the reviews are fake, then I think they should not predict. But whereas if the reviews are not fake, they should be able to predict the fraudulent behavior much more with higher probability. And you see that when we ran this probit model, it clearly shows that the apps on this case, for example, so you have the fraud behavior in this case, and so especially the fraud is very high during COVID time. The probability of an app, can be classified as a fraud app is much higher during the COVID time. And see, for example, the fraudulent behavior is positive. So it has so the fraudulent behavior as identified by the text analytics can predict the fraud, and it's highly significant. So again, this research mainly points out two things, two takeaways. One is, fintech apps exploit when people have more problems with credit access, like COVID time, and that exploitation is there. And the second thing is that text analytics as a tool to identify fraudulent apps seems to be quite robust. So these are the two takeaways. Yeah, thank you.
Good afternoon, everyone, and thank you, Susan and Ajay, for inviting me to the conference. This is my first EMF, by the way. Okay, so I'm from Dvara Research, and we do research and policy advocacy in financial inclusion and social protection areas. So right at the outset, I should say that we maintain a very skeptical stance towards fintech apps. And therefore, I applaud the intent of the paper, but I found many problems with the execution. So I'm afraid I will be quite critical of the paper. But hopefully, you will be able to rework the paper. If you think that my criticisms are valid, rework the paper to make it better. And I'm also happy to work with you on this paper. So So this is obviously a very important and timely subject because the regulatory window has opened for digital lending apps, fintech apps. So papers like this can make a real contribution to this kind of debate that is beginning to now happen. However, there are two overarching problems with the paper. Actually, there's just one overarching problem with the paper, and that is that the paper lacks a proper conceptual framing of the issues. So everything depends on who you want to impact with this kind of a paper. If you're looking to impact, say, the regulator or the supervisor, then you need a conceptual framework. And you need to also speak their language. That's point number one. Even if you don't want to impact the regulator, let's say that you're making this kind of a tool as a public good for, let's say, an SRO. So there are no an SRO is a self-regulatory organization. It's typically an industry association that also functions as a quasi-regulator. It has to get a special permit from the RBI to function in that capacity. At present, there is no SRO for digital lending. There is the Digital Lending Association of India, and then there is FACE, which is a new organization, and both of these organizations are hoping to become SROs in this space. So one possibility could be to create a tool like this and hand it over to the SRO. Or even to hand it over to Google Play, for instance, Google Play Store, for instance, hand it over to Google, although they have their own data science team, so I'm sure that they can do this kind of work themselves in-house. But that is the kind of, I would say, I mean, of course, I mean, you could publish this paper in a peer-reviewed journal, but from a practical standpoint, the kind of tool that you're developing in this paper can be, in fact, made available as a public good to the regulator, to an SRO.
Sorry, just if you could switch to, so that the projector is...
to an SRO, to a financial platform, etc. So in all these cases, if you want to do that, and if you want this paper to have impact, you need a proper conceptual framing, which I thought was lacking. So first I'll make a few criticisms of the method, then I will make a few observations on the data and the results, and then at the end I will give you a sense of how we might have, Dvara research might have framed some of the both the method as well as the results. So first of all, the method does not seem suited. In the literature review section, you end the literature review section by saying that it's hard to tell whether it is the borrowers who are gaming the lenders in this fintech space, or if it is the lenders who are gaming the borrowers, and we are going to shed some light on this issue, but somehow the method doesn't seem to be able to do that, doesn't seem equipped really to do that. But the more important problem is that when you do topic modeling, you have to choose the topic labels. That is something that the researcher provides from outside of the routine, NLP routine. The NLP routine is going to give you clusters of words, but the routine is not going to be able to tell you what the topic should be assigned to that cluster. So that assignment of topic is the work of the researcher. Unfortunately, you do not. This is where a conceptual framing is needed. Okay, and I'll show you how you might begin to give a conceptual framing towards the end of this presentation. But one possible conceptual framing is customer protection frameworks in digital lending. Now, the problem with this kind of ad hoc topic labeling, and I also found that the word clusters contained very generic words. So one problem is that rather generic words such as loan, app, money are being used for topic labeling. You should ideally actually delete these words. Because what they can become boundary conditions for your labeling exercise, and you don't want that to happen, right? So you want to pay attention to the context of the review. Okay. The other problem with this kind of method is that you're taking words that users have used in their reviews at their face value. So a user could be offering a review where the user is just having a fit of rage, or a fit of emotion and saying it's a fraud app, it's a fraud app, it's a fraud app, but it may not be fraud. That is the problem there, you know. It could be poor customer service, but but the user is calling it a fraud, but that doesn't mean that you have to label it as fraud. So that's another problem, you know, when you don't use a proper conceptual framing. So I found, for instance, one of the review examples in the appendix repeatedly uses fraud, etc. But really the problem seems to be one of poor customer service, which in fact is one of your labels. But instead, you'll probably label this as fraud instead. Okay, the third thing is that, sentiment analysis, my understanding of this kind of work is that LDA is not by itself sentiment analysis. It's really the LICW which is sentiment analysis. But my question is, why not do one or the other? Why do both? There's a kind of conflation that happens when you try to do both on this kind of a data set, because you're then saying that I'm looking for negative emotions or negative tones through the LICW analysis. I'm looking for negative emotions and negative tones in reviews that I have categorized as positive in the LDA context. Okay, there's a kind of a problem there, in terms of setting up the issue. But even let's assume that sentiment analysis is necessary of the LICW type. Again, there is not a sufficient parsing for context. So for instance, in your negative tone, the words that you're using, you have a generic word like too much. But, again, that can become a boundary condition in your connotation exercise. And you don't want that to become a boundary condition. So you should probably drop those kinds of generic context-independent words. Finally, and this is another, I think, big issue with this paper, which is that there is no consideration of the COVID event itself and its possible impact on borrowers' psychological state. So I feel that your hypothesis is not properly framed. Your hypothesis states if fintech benefits people with lower access to finance, it should be more accessible when borrowers have limited or no access and are in financial distress. I would argue that fintech's purpose is not to relieve financial distress, and it is not to solve for events like COVID. So to hold fintech, of course you're holding fintech to this standard retrospectively, but that's a problematic way to frame the hypothesis. So I feel like your hypothesis needs to be properly framed. Again, for that, a conceptual framework helps. Okay, on the data and results. So there are some issues with the numbers in some of your figures. They don't actually add up to 2 million, 2.19 million. So just check it. Maybe it's a typo, I don't know. Now, in table 3, we are told that you're going to compare topic means for LDA variable, positive and negative variables. For the non-technical reader, you should basically explain very simply what a topic mean is. But more to the point, let's say I find a statistically significant difference between the topic mean before and after COVID. The question is it actually from a magnitude perspective significant? So the topic mean, for those who don't have background in this sort of analysis, it's basically the probability of assigning to one particular review a certain label. And so the mean for recommend the loan app before COVID is 0.35, after COVID it's 0.34. Now, that difference is statistically significant, but the question is it actually significant? I mean, is it an appreciable decrease in the probability? I would say no.
Sorry, may I request you to summarize we're sorry we're running out of time, so I request you to summarize the next minute.
So I have a long way to go, but I'll cut it short. Okay, so there's okay, I'll skip over this one. Now, how is it that APRs on COVID era apps are lower, yet the negative LDA topic of high interest and charges is significantly more likely for the COVID era app? And I would say that this is one indication that some allowance needs to be made for a time effect, which is the COVID effect. Now, because you don't have this COVID effect, by the way, I don't know why you're running cross-section regressions. You should be running panel regressions with time-fixed effects, okay? And that time-fixed effect will pick up the COVID effect, okay? Now, if the baseline levels of stress are increasing as a result of COVID, then you're likely to see more negative reviews after COVID. But you're not accounting for that secular, let's call it, increase in baseline psychological stress levels. Okay, I have some other issues, but I'll skip over all of that. I feel that even after conceding that the hypothesis is properly framed and that the method is not full of problems, the results seem mixed. I feel like your conclusions are too hastily drawn. And this is coming from someone who represents an organization which cares a great deal about customer protection and therefore finds fintech apps problematic. But I feel like you have not made your case properly enough. So there are I'll share this PPT with you. Some issues on style and form. I feel like your explanations could be a little better. You use this confusing terms treatment sample, but this is not a difference in difference setting. You're running a cross-sectional regression. Okay, here's how you give it a proper framing. You situate the research project as creating a SupTech market monitoring tool that can be a public good, and it's one aspect of a supervisory tech. Market supervision can partly be performed by the regulator or the supervisor because regulated entities have to report on a regular basis to the regulator. But there are also aspects of market monitoring that can be performed by private actors. Like we do some market monitoring in the credit space ourselves, and what he is doing is basically doing what is called market monitoring, and that is what is often called off-site surveillance. What you should do is situate this project within that context, and here's a framework. And again, I'll share the PPT with you so you can take a look at it at leisure. Here's a framework where you actually have 7 different categories of customer protection risks. 5 of these were identified by FSLRC in 2013. 2 have been added to the list because of data protection issues. Now, if you were to use these categories for your topic labeling exercise, your topic labeling exercise is going to be is going to have much higher fidelity than it has right now. Okay, that's all. Thanks.
Thank you. Maybe I have a minute for a response and maybe questions after that. We can pull in questions.
Thank you. Great review and very rich comments for me to work on the paper. Yeah, so there are some constraints in terms of getting the time effects right. The review dates are not that clear. But I think it's a good idea to have a framework to start with. So we just got a bunch of data. We started exploring the data, and we wrote a paper around the results what we got. So I think definitely I'll consider all the comments while revising the paper. Thank you. I don't know how you can check this. Can you please? I don't know how you can check this, but related to the change in mental states, which Discussant was talking about. It may be a completely different set of customers, right? The people who are applying for a loan during COVID times are not the same people. So it's not just change in psychological state, also the correlation between your different categories. Correlation. So it's at. Thank you.
I get annoyed at say level one in 4 categories, but that combined effect tips me over into actually writing a review. Individually, I wouldn't care, but because I'm pissed off with customer service, fraud, whatever, that's
Combined
when
effect.
so it's not just that I'm going to write a review because of only one factor.
Right.
And I think the Discussant talked about that too.
Yeah.
There's the choice of writing a review or not.
Yeah. So I think combined effect and.
Any questions? Maybe pull in the questions and answer.
I agree with what Indradeep said about mental state.
Yeah.
When you were presenting, I was also recalling a bunch of things. We know a lot from advanced economies about severe mental health problems that surfaced when COVID happened. Now, you could argue that that was because they had more extreme lockdowns and social distancing rules. But then I think that in the Oxford University measurement of the intensity of lockdowns, at least in April and May 2020, India was the world's most extreme lockdown. And if you juxtapose that on top of the financial distress in the hands of a lot of poor people in India, then it was actually potentially a really bad time in terms of state of mental health. True. So I could think of two pathways through which we could address this. One pathway is you've got all the code. Right. So imagine you run it for a app category that is not affected by the COVID events. As an example, take Tetris apps, take weather apps, okay? Take some harmless category where nothing much happened in the COVID period. For example, I would not say food delivery apps because they actually experienced explosive growth in that period. Right. So treat that as a control that, nothing much happened on a weather app or a flashlight app or a Tetris app. And if reviews got a lot worse, then we could attribute that to mental health issues. Okay?
Yep.
I can think of an objection. Maybe I was superficially playing Tetris earlier. Maybe I was whiling away my time at home in the lockdown and I was intensively using the Tetris app and I discovered all the bugs in the app. Okay, so you need to think more, but that's just a conjecture. So that was one idea on what could be done different. Then I've just blacked out, sorry. I have a senior moment. I had a second idea on how to attack this problem, but I can no longer figure. Second simple idea. Again, use the Oxford data set on the intensity of the lockdown. And what you see in India is a sudden sharpness of an intense lockdown. And in about 2-3 months, it started retreating. And particularly, I think there are some data sources, the Google mobility data. It basically shows that the further away you are from Delhi, the more the lockdown spontaneously collapsed. Okay, so people in Kerala and people in Tamil Nadu started violating the lockdown and getting about their own business. So distance from Delhi is an interesting proxy for intensity of lockdown. So I was wondering whether there are some angles on exploiting certain dates by which you could reasonably believe that the bulk of the country has exited the lockdown, and is the behavior vis-a-vis these apps qualitatively different. So the craziness that people felt in their heads was related to the intensity of social distancing.
Right. Thank you.
First, and I think Ayush after that.
So I had a more general question and a comment on fintech lending through apps, right? Which is that the phenomenon or the psychology of reviews, if I were to extend that to newspaper reporting, and there is literature that suggests that negative news gets reported much more frequently than positive news, right? Which is all of this stuff about farmer suicides because they are customers of lending apps. Do we have a sense of priors as to how, the positive effects of lending to this sector, assuming the fact that the borrower profile are those borrowers that are left out of the traditional banking system for whatever reason, in which case that the cost that they're bearing is paying higher interest rates, but they actually have access to credit. So do we have any priors on this to understand? Because I mean, picking up just negative reviews, for example, may not give us an entire picture. And say, if we were to go with the psychology argument, that if something went very, very well, perhaps I'm more likely to write a positive review versus not. Or even if things went well, I may not even write a positive review because it's gone well. So, can we think about this in that context and get a sense of the cost and the benefit of this without only looking at it from the negative angle?
Yeah, so, I'll take,
Yeah, so I was thinking maybe the negative reviews during COVID may not just be psychological. Maybe there were just more defaults and hence more conflicts during that time. because people were generally short of money. And one way to control for that would be to look at apps that were launched before COVID, and then looking at the reviews of those apps. And then
I've
that
done
would
that.
be a, you've done that?
Yeah. So that has been addressed. No, in fact, in the analysis, if you read the paper, we look at the apps that were issued before, and we do pre and post kind of analysis and compare that with the post-COVID apps. So post-COVID apps seems to be relatively more negative compared to the pre-COVID apps. So, and going back to the other question, see, it's difficult to have priors on this. So we are now setting up a lab experiment where we develop apps. So some of them with fake features, some of them with genuine features. And we try to run a few experiments to see how people use apps and what kind of app features lead to problems. And we are using eye tracking devices, to see how people navigate through loan apps. So, so it's a project that we started a few months ago. So I'll have some results, going forward.
So maybe one thing that one could do is look at who's borrowing repeatedly from these apps, right? And that may give you a sense of who's constrained to borrow in this sector and who is, whether or not they have negative reviews, they are continuing to borrow from this, in which case it may actually be beneficial that they're at least getting some access to credit.
It's hard to track the data because, most of the people who borrow, they don't really let us know whether they're borrowing or not. So data is a big issue here. The issue is big, but, you won't get data anything, to work on this issue. Thank you. So, thank you very much. Yeah, I will. Yeah, thanks.